Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Someone said to me yesterday that you and I do good harmony on the Money Café, but Stephen and I don't work. I'm not sure that's true.
Oh, okay, right.
I thought that was very nice.
Not often I'm complimented on my harmonies, so I appreciate that person.
So what do you reckon about the interest rate cut?
Oh, I thought it was weird. I mean, as you know, Alan, I've been predicting an interest rate cut for like a year in February. So
and I've been predicting that they wouldn't cut.
Yeah, so I feel vindicated.
I changed my mind. Changed my mind a few weeks ago.
Yeah.
Anyway.
Well, I've been on this bandwagon for a year, but I thought it was an awkward, uncomfortable, caveat-filled cut that they didn't really want to make. I mean, you read the statement. Michelle Bullock did a good job of explaining it in a press conference, but the statement was basically explaining why they shouldn't have cut. I just found it such a low conviction move. It just opens them up to the suggestion it was more political than economic. You can make the economic argument, inflation's falling, but the whole statement was about, we're really committed to getting inflation down. We don't think we're there yet. So why the cut?
I don't think it's political. But I do think that they are really reluctant to go against almost 100% market expectation.
Yeah.
Because it's such a shock. If they do that, it's a really big deal, right? So
they were cornered.
23 out of 25 economists were predicting a cut. Market expectation had been 99% a week ago, and it was kind of down to 92 or something.
Yeah.
But still, it was really
one-way traffic.
Everyone was on one side of the boat. So, I mean, but it was interesting. But you look at their forecasts in the monetary policy statement that came out.
Yes.
And it's quite clear why that is, because they're forecasting that unemployment is falling, not rising. I mean, it has been falling. Unemployment's come down from 4.2 to 4% in the past 6 months.
Yeah, I mean, I just don't quite get. I mean, I think they said in the statement quite explicitly, a cut risks inflation rising again, according to our forecasts. I don't. Anyway, I'm not sure I quite get it. But look, the interesting thing for me, the question that wasn't asked at the press conference that I would have loved to have been asked, is will the RBA and Bullock feel embarrassed if they have to hike again in, say, the next 12 months?
Well, yeah, you don't have to ask that. Of course they will.
But I mean,
that'd be terrible.
Or would they just say, well, this is the price of being data dependent?
Oh, they would say that, of course.
They would say that, but I mean, interesting. I think it's an interesting question.
But surely the Fed is embarrassed because they cut in September, and now they're talking about hikes.
Yeah.
So that's pretty bad. I think it makes it look like the September cut was a mistake.
Yeah.
So you don't want to be people saying, "Oh, that cut was a mistake." I would have thought.
But the RBA's had the chance to learn from that.
Well, yeah, I know.
And as sort of,
but the thing is that the economy is not behaving as it should.
No.
So, and the thing is that they've got wage growth is declining, yet unemployment is not rising. So the link between wages and unemployment has broken. And they don't know what to make of it. I mean, and I was looking at a press conference. It's quite clear that they don't really know what to make of that.
No, they don't know what's coming next.
No,
which is why it gets back to my data-dependent question. Maybe the response is, well, yeah, that'd be fine. We were in a brave new world, and wouldn't crush our credibility. I don't know, but it's a weird spot. I mean, we're in the middle of reporting season at the moment. So February reporting season, companies are releasing their results for the half year to December 31. There's very little signs of weakness. There's pockets of weakness, but if you look at Commonwealth Bank, JB Hi-Fi, Bendigo Bank, the economy's holding up very well. Consumers are very resilient. There's even a little bit more discretionary spending going on.
Well, what's resilient, what has been resilient for the past 2 years, is the number of consumers.
Yeah, that's
Individually,
true.
Consumers are not resilient. Individually, consumers are in poor shape, it seems to me. Consumer sentiment is really low. On a per capita basis, disposable income is down a lot. most in the world.
Yep.
But what's held up is the number of consumers through immigration.
Yeah, right? Good point.
And also government spending, which is the other thing that's holding the economy up.
Yes.
Government spending.
Yes.
So yeah, I mean that's what's holding everyone up.
Yeah. Would there be a more relieved duo in Australia yesterday than Anthony Albanese and Jim Chalmers?
Yeah, I mean, do you really think that makes a big difference to people's vote?
Oh, I think it does. Yeah. Well, I think they think it does, but I think it's a signal that to some people that things are turning. Yeah. Yeah.
Yeah. Yeah, you're right. I guess.
I mean, yeah. All the chatter around is now that we could see an election called in the next week or so. Try and get it in before Easter.
I mean, they're clearly in trouble, Labor, aren't they? I mean, they're in serious trouble.
Yeah.
A serious possibility of losing their first election.
Yeah, yeah. And I think where we are in Victoria is a big part of that.
Yeah.
The sentiment here towards Labor in Victoria is very poor. I did a Seven Group, which is the big sort of conglomerate that owns Seven West Media and Coates Hire and Westtrack, a big, Ryan Stokes is the CEO there, Kerry Stokes' son. Entirely unprompted, you ask him about economic activity around the country. Oh, Victoria's in recession. No two ways about it. And you sort of think, recession, that's a big call, but it sort of makes sense. So, we're in a per capita recession and Victoria's lagging the rest of the country.
Yeah.
So this could be where the coalition wins a lot of seats. But they do need a hell of a lot of seats to regain government. That's their problem,
but isn't it the case, I mean, just talking about politics, isn't it the case that it's really about who's got the most seats in a minority government?
Maybe.
I mean,
maybe, yeah.
It seems to me that it's going to be a minority, however what goes, it's going to be a minority, and it's a question of who gets to do a deal with the crossbenchers.
Yeah, probably. It's going to be a big sort of 5 or 6 weeks, I think.
Speaking of the reporting season, I was interested in your piece on BHP, which...
Yeah.
I mean, look, I suppose it's not a surprise the way that Mike Henry's transformed the company from the focus of the company from iron ore to copper.
Yes.
But it was just interesting to read it, how big a deal it's been.
Yeah, well, I mean, so iron ore has been for the last 25 years the centre of BHP, centre of BHP's universe. As recently as 2021, 70% of the earnings came from iron ore. All of a sudden, in the last half that's gone, 39% of the earnings are coming from copper, up from 25% a year ago. So there's been this big transformation as BHP has pushed harder to increase copper production and basically left iron ore production flat. Now, the iron ore business is humming. It is humming. Like, inflation's running 3.7% during that period. BHP managed to reduce their cost in iron ore by 3.9%, which is a phenomenal.
How are they doing that?
A bit of automation, better processes.
Are their mines in the Pilbara basically run by robots now?
No, I don't think so. But a lot of the logistics is, automated trains and all that sort of stuff. So, but Mike Henry's been fabulous at that. But all the growth capital's going into copper, particularly in Chile. Olympic Dam is really starting to hit its straps. They've got some other mines in South Australia. Got this big project they're starting to get off the ground in Argentina. So it's really a changing story at BHP. And think about the next 30 years, iron ore prices will be under pressure, gentle pressure, still be a great business, but supply and demand's changing. In copper, demand's going one way and supply's not coming on very quickly. So,
do you think they'll ever regret not getting into lithium?
No, I don't.
Right.
I mean, there's different views on lithium, but lithium is everywhere. It's hard to get a cost advantage over anyone else, like they've done in iron ore, where they're 10% cheaper than everyone else. So I don't think they'll regret not getting into lithium. I think it's going to be a tough game.
Maybe that means Rio Tinto will regret getting into lithium.
Perhaps. I mean, I guess the good thing about Rio Tinto is they're big enough to survive these big price movements. Lithium's a bit like Bitcoin, the price can go up and down by 70 or 80%, and little guys can't sustain that, big guys can.
Yeah.
So, yeah, it's interesting that their paths are divergent, though.
And what do you think of the reporting season overall? You watch it more closely than I do.
I think the vibe's been pretty good. There's been more beats than misses. Corporate balance sheets are in unbelievably good nick.
Yeah.
Like, there's no great globs of debt anywhere in the public sector.
Public sector, you mean?
Sorry,
publicly
publicly listed companies, I should say, yeah. So there's lots of debt in the public sector. So, yeah, I mean, I think companies are in pretty good shape. The caveat, I think, is that the market's very expensive. You know, we keep hitting these all-time highs and the earnings aren't really coming through. So, you know, if we get 1 or 2 or 3 rate cuts, that's probably not going to stimulate the economy enough to drive earnings. So that's the big question mark. There's a gap between what people are paying for companies, the valuations, and the earnings that are actually being produced.
And no more so than in Commonwealth Bank, possibly.
Totally.
I mean, I'm going to record a piece today for Sunday on the news about the CBA bubble.
Yeah.
Which goes on. It's incredible. Really.
Yeah. And I mean, look, this is you would have a broader sweep of knowledge. I can't remember a bank being better run than CBA in the last 20 years. It's a phenomenal franchise. Like what they've done to, you know, one little example, 75% of mortgages are sold by brokers in Australia and in most of the banks. 66% of CBA's mortgages are sold through their own channels. So only 34% of their mortgages are sold via brokers because they've managed to retain these customers in their own ecosystem. It just shows the strength of their customer franchise. You know, they got 35% of Australia in the bank. But for all of that, the valuation doesn't make sense.
But are the mortgages they sell themselves, are they more profitable than
20 to 30% more profitable?
Right.
And what are they doing with that? They're reinvesting it in better prices and increasing their market share. It's a phenomenal bank. And, you know, the gap between them and the rest in technology, for example, they're just outspending everyone. So, but again, does that justify the valuation, which is the highest in the history of the developed world? I don't know.
Is it the highest in the history of the developed world?
That's what analysts like John Mott from Barrenjoey say.
Right.
So, you know, we're out there. We are out there. And what's driving it? Well, it appears to be super funds.
Appears to be what?
Super funds. Huge flows are flowing into the super funds and into ETFs, passive investing. Where are they going? They're going to the biggest companies. Yeah. And they just keep grinding higher.
So does that mean, do you think that the CBA can just sustain this kind of
I'm not sure.
valuation?
I guess I would, The counterfactual is the tough one. What makes CBA fall? What brings the valuation down? And nobody can figure that out. It's in the stratosphere now. How does it fall? I don't know. But yeah, CBA bubble's a good topic to get into.
Yeah,
I'm not sure what pops it.
Now we've got a few questions about Trump, so we might, or a couple of questions about Trump. I think so we might leave that for the questions.
A couple of criticisms about Trump.
Yeah, so let's move on to questions. Before we do that, let's have a quick word from our sponsor.
Are you looking for your next investment opportunity but not sure whether in Australia or overseas? With the Intelligent Investor Select Value Share Fund, you can have the best of both worlds. The actively managed ETF invests in the best growth opportunities at home and abroad, giving you exposure to a diversified selection of companies with superior financial metrics and competitive advantages. For a limited time, you can invest in the fund with zero brokerage fees directly with Intelligent Investor. Learn more at offer.intelligentinvestor.com.au/IISV.
Yeah, so first two questions are about US. So let's just, Jason, I'll do the first one. You can do the second one.
Sure.
We'll talk about it. Jason says the US is already borrowing at massive levels. With Trump back in office pushing tax cuts, the debt burden looks set to grow even further. If any country were doing this, their currency would be in free fall, but because the US dollar is the global reserve currency, they seem to be getting away with it. How far can this go before the world decides enough is enough? you go next.
And Isabella's got a similar question. Will we see some move away from the domination of American equity markets in global equity markets? She's got used to, like everyone else, sort of those 8 to 12% returns from passive index investing in the US market, but will that continue if the US domination recedes and the rest of the world comes into vogue?
Yeah, so look, I can't look. The truth is that the fiscal rules are different for the US because it is the world's reserve currency, right? So it is the case that if any other country had this kind of debt and this kind of forecast debt, the bond market would be giving it an absolute spanking.
Yes,
but it's not, because everyone has to own US dollars and the world has to own US bonds, so they can't. So it can't actually happen. But the question is, is there a comeuppance at some point? And the thing is that it is the case that the debt always increases under Republicans.
It is,
and possibly even more so than with Trump. I mean, all this hoo-ha about Doge, what Musk is doing, the Department of Government Efficiency, and also the tariffs. It seems to me they're all mainly designed to pay for Trump's tax cuts.
Yeah.
Right,
I think that's a good way of thinking about it.
I mean, he's in the hole for at least $3.5 trillion of tax cuts over 10 years, right? So, like half a trillion, $500 billion a year.
Yes,
and that's what he's. And the thing is that it's always easier to do a tax cut than it is to find the savings.
Yes, right? Very true.
That's the reason of debt increases under Republicans, because they do a tax cut, saying they're going to find savings, and they can't find the savings.
Yeah.
But they can do the tax cut.
I think though the bond market will be is taking comfort from the Doge thing, because it shows that the Trump administration is at least trying to get those two forces working against each other. So they're not just ignoring the deficit. In fact, they're talking a lot about the deficit and the 10-year bond rate. They are saying we want that 10-year bond yield to come down. So I think the bond market's hearing that and saying, all right, okay, we're going to have a tax cut. It's not great for the debt budget position, but at least they're trying. They are making the right noises about reducing the deficit. As for Isabella's question about US equity market dominance, I think this is the great debate on markets. We've seen a big push into markets outside the US in the first, 6 weeks of the year, 7 weeks of the year. So markets in China, even Germany, where the economy is supposed to be stuffed. China, Germany, they're all up double-digit percentages. So we are seeing a move out of the US. I wouldn't be overly concerned about this sort of that the US is going to become some investment wasteland. It's still the leader in technology and innovation and dynamism. And
I still think there's no alternative, really. I mean, how can you invest in Europe? The economy is the European economy is still in trouble.
Well, you can see China and Europe as trades this year. China's going to have to stimulate their economy, just going to have to, or else they're in trouble. So that stimulus should lift markets, and Germany's probably the same. They also might get a tailwind from if there is a peace deal in Ukraine and Russian gas starts flowing back into Europe. That would help Germany, lower energy prices. So you can see why short-term trades in like China and Germany and Europe might work, but I think the long-term bet around America is still pretty safe.
Me too, I agree. John says, well, I understand the PM has lobbied the President Trump to exempt Australia from executive order to impose 25% tariff on steel and aluminium. I'm wondering what implications such a tariff would have in respect to the many goods we import from the US that contain steel and aluminium, particularly in the light of the very favourable trade surplus the USA enjoys in the trade with Australia. So, yeah, look, I think that's a factor.
It's a factor,
probably.
yeah.
I mean,
I think these things are at the margins.
Yeah.
In fact, I wonder, we heard this news about the tariffs on steel and aluminium, and everyone rushed to say Albanese needs to get an exemption. We don't really export that much steel or aluminium to the US.
No.
I just wonder if that's a waste of political capital.
No, it was turned into a big political issue as to, whether Albanese can stand up to President Trump and all this stuff. It was all
silly.
Yeah.
Deb and Simon have similar questions about the possibility of helping the housing crisis by some sort of rent-a-room program, where the people who rent the room would get maybe tax-free income. Simon linked this to he's a historian.
Where's Simon?
I've praised his comment.
Oh, I see, right.
Simon, he's a historian, linked this to the return from war, when a lot of people put soldiers up for lent their room to soldiers, and that was a very sort of common thing to have a border. So both of them are asking, could we some sort of program where you let your room to a border and you don't have to pay tax on that income? Could that work to help solve the housing crisis?
No.
No, okay.
Well, no. Look, I think it'll be okay. I mean, it's a good thing to do, but don't expect it to solve the housing crisis.
Yeah, no, I'm not. Help the housing crisis,
I'm not,
I should say.
I wouldn't be against it. It'd be fine, but
yeah.
Probably not a bad idea to give tax relief for it too. I mean, how do they encourage people to let their rooms to soldiers? What do they do? Do you remember what they did?
No,
did Simon explain?
No, he didn't. But it was common thing. There was some, he did say there was some sort of tax relief, or there was incentives to do so.
Right.
And Deb's pointed out that there's programs in the UK, Norway and New Zealand where you get tax relief to do these sort of things.
Okay, well.
Could work.
No.
Chris says he loves the podcast and makes it a regular part of his morning walk. Over the next decade, Gen Xers will be retiring in droves. Most of them will be sales-funded retirees who've contributed to super most, if not all, of their working life. I assume the government has forecast potential savings in pension payments. Do you know what the potential savings might be?
No, I don't. But it is. But they are expecting some kind of savings. But it's not. I don't think the savings are anywhere near what might have been expected. I mean, it's taken a long time. We've had super since for what is it, 20, 30 years? 30 years.
Yes.
Still waiting for pensions to start falling. Age pensions, not happening yet.
Yeah, it should happen over the next 20 years, though.
Yeah.
Because the super balances that people are retiring with are big now, and they'll be supplemented with ever decreasing amounts of pension help. So it is going to happen, and it will increasingly happen, and we need it to happen. That's the whole point of the super system, right?
Yeah.
Can I summarise the next question from Christine?
Oh, yeah.
Alan?
It's
so
taking up a whole page.
She listened with a bit of frustration to your debate about property and shares last week, which is the better investment. She says it was painful listening as you and Stephen waffled on. And she says the numbers are
Did she say waffle?
Waffle?
She says waffle.
After hearing you two
Jeez,
waffle
Catherine,
on.
that's a bit hard.
So Catherine says, look, the numbers don't lie. Shares are clearly a better investment than property. But her point is we need to stop sitting on the fence and tell people to stop buying property as a form of investment. Housing is a fundamental human right, as you have noted in your book, and should never be considered a speculative investment. I've been shouting this from the rooftops, and I expect you to be doing the same.
Well, I have been doing the same. That's exactly what I've been doing.
I've been thinking about this question, Alan, and I get where Catherine's coming from, but we do need people investing in housing. We do need housing investors. I mean, the assumption in this, Catherine's assumption, is everyone wants to own a house or can own a house. There will be situations where people need to rent. I'm thinking students as they move in, out of home and into their first. Who owns the houses that the students would rent, if not investors? I mean, speculative investing, I get the point there. And maybe there's a difference between regular investing and speculative investing that we need to, rein in. But we do need property investors.
Yeah.
We do need them in some form.
We do, that's right. A lot of other countries have institutional property, residential property investors. We don't have that in Australia because of negative gearing.
We're trying to get build to rent, right?
We are trying to get build to rent.
Yeah.
And a couple of concessions are done. But the trouble with build to rent, the trouble with property investing in general is that any investment has to return its cost of capital.
Yeah.
Cost of capital is 6% or whatever. It's at least 6, arguably 9 or 10.
Yeah.
So therefore, for that to work as an investment, the capital growth has to be about 6%, right? Well, that's how we got into this trouble, was residential property growing at 6% a year. I mean, so I understand we do need. I agree. We kind of do need people who own houses and rent them out, or blocks of flats or something. But I can't. I'm having trouble joining these particular dots.
Yeah.
Of okay, we need investors, but we also need housing to be a terrible investment.
Yes.
We do.
Yeah, or just a mediocre one.
Well,
just an okay one.
We kind of need, in order for the housing affordability to get back to something approaching normal or what it used to be, we need zero capital growth for a while. Which means that if you're an investor in housing, you only get the yield.
Yeah.
Which is like 3%, if you're lucky.
Like a CBA share.
Well, at the moment it is. That's right. Well, everyone's buying CBA and getting 3%, but it's fully franked. The trouble is your yield on a house or a flat is taxed.
Yeah.
And not only that, you've got to deal with bloody tenants.
Yeah.
So, look, I agree. I think we need to be in a situation where investing in houses and flats is terrible. Is not a good idea.
There you go, Catherine. He's off the fence and he's not waffling.
I haven't been on the fence for all. I'm not on the fence.
Don't be defensive.
Kevin says, I listen to a number of podcasts, and yours is one of my favourites. Quite often in these podcasts, the idea of company tax cuts is put forward with glowing reviews from most economists. They always say that it will encourage a new wave of investments, but will giving Aristocrat Tabcorp a tax cut really do this, or will it just be lazy policy? Yeah, I agree. I mean, I don't think tax cuts will encourage investing.
I guess again, Kevin, the counterfactual here is that if our company tax rate is way out of whack with other places, does that discourage investment?
Oh yeah.
That's the problem. If they're paying, I don't know, picking numbers here, 20% in the US, 15% somewhere else, is there capital flight, and does Australia lose out? That's the problem.
Yeah, I think you need to worry about that, and it also is the case that the people who pay the company tax is us.
Yeah,
I mean, the company is just a pass-through mechanism, so they just collect. They just collect the tax. I mean, there is a case for abolishing company tax entirely, and keeping it as a GST. But look, I don't agree with that. I'm just saying that.
Yeah. Sally's a loyal listener, and she loves the way we make her laugh. It's not always our intention, Sally, but sometimes it is. She's got a question about housing as well. How do you balance the needs of different groups? Those who need affordable housing versus those who rely on high property values for their investment in business. And this is not just an Australia issue. This is an important point Sally's making here. This is a problem in most developed countries. Do we just have to accept this is the way it is for the future, or is there a realistic path to reversing the trend?
Yeah, fair question. I mean, the first thing is that with housing, we can't have it both ways. We can't have a return to affordable housing and housing being a good investment and people making, growing their wealth.
Yeah.
Can't have it both ways. So we have to go through a period where housing is not a very good way to build wealth. Or else we just don't worry about it and, just get used to it. As for the rest of the world, yeah, it's true. But I think although it is a global issue, the solutions are all local.
Yes. Yeah.
There's no global solution to this.
Yeah.
Each country has to deal with its own particular problem in its own particular way.
Yeah.
Whatever that might be.
Yeah. We can take things from other places, though. I don't know if you noticed recently, but some of the banks are freeing up their lending practices around modular housing.
Oh, yeah.
Which is very big in Europe. 70 and 80% of the houses in Germany, for example, are modular in some way. Like, that's a good thing. Let's get that technology happening. Let's get the construction costs down and supply increase. Yeah. So we can borrow things from around the world, but yeah, it's a vexed one. Alex
says, I know that trying to understand the stock market is like grasping water, but I can't figure out why Sigma Healthcare's shares aren't trading higher post-merger. It's got a market cap of $30 billion. It's a merger with Chemist Warehouse and other listed companies with a similar market cap are trading $20 plus. Help me understand. So come on.
Well,
help Alex understand.
The reason the shares aren't trading higher, Alex, is because they're extraordinarily richly valued at the moment. I think this company is now trading on about 65 times earnings. Now, that is the sort of price to earnings ratio usually reserved for tech stocks that have lots and lots of growth in front of them, right? That is not the sort of price to earnings valuation.
And do you think Chemist Warehouse can grow?
Oh, I think it can,
like rapidly grow.
I think it can grow, but can it grow into a PE ratio of 65? Not sure. And so I think that's why these shares are already very richly valued, Alex. They've run extraordinarily hard in the 12 months it took to get the Chemist Warehouse deal done, and I think we'll see a bit of a pause for a while, as we should.
Josh says, I enjoy your podcast, particularly interested in the airline industry and an announcement the Australian government may be willing to purchase Rex. How does the Australian government justify spending taxpayers' dollars on what is clearly a poor investment? Well, isn't there a market failure in regional transport? I mean, the government has to do something about regional transport, right?
This is a tough one. I get where Josh is coming from. These transport routes that Rex provides to regional centres are vital. There's no alternative. You can understand why the government stepped in. But Josh is right. This company got itself into trouble by taking a ridiculous swing, borrowing $150 million off a private equity firm and deciding to try and compete with Qantas and Virgin on the Golden Triangle routes, Melbourne, Sydney, Brisbane. History says it never works. You can't beat those guys, and yet they did it. And when did they do it? In the middle of bloody COVID. I mean, if there's a company less deserving of a bailout, I don't know what it is. And there is moral hazard in this, but I get what you're saying. I don't know what else the government can do.
But you're right. That's the reason Rex went broke is because they mucked it up. Yeah. I mean, they made a stupid decision. The fact is, however, that we're not talking a bailout. We're talking about the government preserving regional airline activity,
by using your and I money to buy the thing.
Well, what else? It's going to cost the government money, whatever they do. I mean,
so.
But I suppose the question is, can anyone make money out of a regional airline?
Well, we're about to find out. I don't know. Are we going to get cheap? Are we going to get a taxpayer discount when we fly? I'm not sure.
Well, we show our... I'm a taxpayer. I need a...
But think about this, Alan. Let's say they buy it, right? And in June this year, they own it. What's their strategy going to be? Are they going to be a price-led airline? Are they going to be a differentiated service airline? Smaller jets, better service on the flights? What's the government's marketing strategy going to be? I mean, this is just so fraught. It's so fraught. And the next private company that owns a bit of important infrastructure, do they have a license to say, let's just have a big swing for the fences? Let's take on the debt, take on the risk, because the government will just end up buying it. I mean, I agree. What else can the government do? But I'm with Josh. There's a bit of moral hazard here.
Okay.
Kaz says, can you suggest a beginner-friendly platform company to invest in shares while at the same time learning the process of buying and selling them?
Oh.
Well, look, I mean, Kaz, like the ComSec platform, I don't want to pick one, but there's lots of online platforms that make the process very easy these days. You can open a ComSec account in 5 minutes. There's lots of other online platforms that let you invest very small amounts, so you can just have a muck around, and learn the process. It's actually a lot easier than it used to be through these online platforms, and there are a few that do sort of zero or very low cost transactions as well. So hunt around.
Greg's saying we have to do one more question.
Right. Greg's the boss.
It's got to be Wayne, doesn't it? I mean, it's not a question; it's a comment. I've been listening to this podcast since the split with James Kirby. You're talking about. I've had enough of the Trump bashing and I'm unsubscribing. I'm very disappointed that you can't keep your bias to yourself.
Well, Wayne's not going to hear this.
He's unsubscribed.
Yeah, he's unsubscribed.
It's a pity we're not a subscription service. It's free.
Well, too right. Because that's all it's worth to Wayne. Look, Wayne, I get where you're coming from, and I'm getting a lot of emails like this, Alan.
Yeah, me too. That's why I thought it'd be worth putting out there because, I get a bit of that too.
I mean, I don't know what you think, but politics is so enmeshed in financial markets and investments at the moment. What is happening in the US is flowing through to bond yields, as we've explained today. It's flowing through to the differences in asset allocations between the US and other parts of the world. All of this stuff matters. The global markets are so enmeshed in politics. They're so enmeshed in everything that's going on, including the Doge stuff and the Trump stuff.
Well, and
you just can't
also,
separate them.
Also, the relations with between the US and Europe and what's going on in the Middle East and Russia and Ukraine. It's all part. I mean, it's all part of life. Investing is part of life. This is life.
Yep. Well, look, I mean, I don't think whatever your views on Trump personally, that his actions are having impacts on markets in real time. The gyrations we've seen around tariffs. So you have to have a view on, is that sensible or not? Is he bluffing or not? All that stuff matters, and I think, like it or not, we're going to have to keep talking about it.
Yep. Sorry, Wayne.
And look, at the end of the day, it's it's the greatest show on earth, right?
Yeah, that's right. It's fantastic. Absolutely fantastic.
Yeah.
Okay, thanks for listening, everyone, to today's episode of The Money Café. I'll be back next week with Stephen Main. Send in your questions to themoneycafe@eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report and a finance presenter and columnist on the ABC.
And I'm James Thomson, senior Chanticleer columnist at the AFR.